The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everybody, and welcome to our first financial reporting and accounting webinar for 2014. This is the first of 8 scheduled webinars for 2014. I'm Aletta Boshoff, and I work in the technical team at Pitcher Partners. Before we start with this webinar, maybe just a few admin arrangements. First of all, if you look on the right-hand side of your screen, you should see a chat function or a question function. Now, you should be able to type in a question, and earlier I've said, if you found it, could you please send me a friendly hello? So please look for that chat function or question function. So throughout the presentation, if you would like to ask a question, you can post it there. I will try to respond to those questions as we go along. However, sometimes, even though I'm a female and I'm supposed to be able to multitask, I struggle to be talking to slides and read questions and think about answers. But I've got a document that would give me all your questions that's been asked during the webinar, and I can follow that up with you. So please post your questions when you think about them. So the chat function is very good, and I've got an Afrikaans good morning there as well. So welcome, nice to have you here. There's also a highlighter, or it would be presented as a little yellow paintbrush. And if you click on that paintbrush, you might be able, at certain times, make some notes on the slides as well. The other thing, I have emailed out the PowerPoint slides for today's presentation. I hope you've received it. If not, if you can contact me and I'll give you a copy. However, the PowerPoint slides that you've got is not exactly the same than the ones I'll be using today. The only difference is sometimes I ask a question and you won't have the solutions. So you can page through your PowerPoint slides, the solutions are not there. However, on my screen, I will in due course display the solutions as well. So don't stress if my slides at times look slightly different to yours. So thank you very much for joining us. We hope it's a useful exercise and good use of your time. And let's start. So I thought, it's just been the Australian Open, how lucky we are to have the Australian Open in Melbourne. So who is your all-time favorite tennis player? If you can use the chat function to let me know, who is your all-time favorite tennis player? I've given you a few suggestions there. Roger Federer, I do love him. Rafa, Steffi Graf, isn't she amazing? Leighton Hewitt from Australia. But I have to agree with Scott. I absolutely love Andre Agassi. Quite a few that go for Agassi. There's Rafa's. Yes, I agree. Andre Agassi in this photo, he's got the shaved head. In the young days, the wild days, you know, he had the mullet hair. I love that too. I love Andre Agassi. Doesn't matter what he looks like, he's so nice. Mark Philippoussis, that's a good one. Ivanovic, yes. Yes, the bandana was good as well, Christine. Maybe just on this point, I know there are some of you that are sitting together in a boardroom attending this webinar. So if one of you could put in an answer, that would be great. But if you don't want to, happy for you to just discuss it in the meantime amongst yourself. The whole idea of these questions and the chat function is to have a bit of interaction, for me to see that there are people out there. If you want to ask a question, you can at least say that. But if you want to have a chat amongst yourself in the boardroom, have fun. So, listen, I saw a lot of Agassi's. There's an Edberg, Ivanovic, Federer. I'm not biased at all, but therefore I'm going to conclude this and say we've decided, based on this scientific research, that it's Andre Agassi. All right? No bias on my side. All right, roadmap for this session. We're looking at AASB 13, fair value measurement. 7 sections. We'll start with background. Then we'll look at the definition of fair value. Then we'll look at special considerations for non-financial assets. We look at special considerations for liabilities. In Section 5, we look at valuation approaches. Section 6, we look at valuation techniques. And then in 7, we look at disclosure requirements. So 7 sections that we work through. So if we start with the background, the development. So for many years, the International Accounting Standards Board and the AASB have been issuing standards where somewhere in the standard they would require or allow the use of fair value measurement. We think of AASB 116 property, plant and equipment, where you have an accounting policy choice to have your property, plant and equipment subsequent to initial recognition at cost or revalued amount, fair value. We think of investment property. So a number of standards have required or permitted the use of fair value. However, all of those standards then also proceeded to explain how do you determine fair value for property, plant and equipment, how do you determine fair value for financial instruments, etc. They've all been developed over time, and recently the International Accounting Standards Board and the AASB realized the guidance on how to measure fair value in all these various accounting standards are not necessarily in line, not necessarily consistent, and we have to fix it. Because it's inconsistent, because it's not the same, it's confused people. Therefore, they've issued AASB 13, and they've said this is a single standard that addresses how do we determine fair value. So AASB 13 is the first accounting standard to tackle that concept of how do we measure fair value. It's all about measuring fair value. So there are many standards that require or permit the use of fair value, and AASB 13 is central to all of these standards. If we look at a few examples, we could say it's required by AASB 116, 132, 139, 140, investment property, agricultural activities, etc. But on the right-hand side, I also have there in its own little block AASB 1004 contribution. So even if you are a not-for-profit and you receive a non-reciprocal transfer and you use AASB 1004, you have to measure that contribution at fair value. And AASB 13 should also be used by not-for-profits when they apply AASB 1004. So AASB 13 is really sitting in the middle of all these accounting standards developed for for-profits, not-for-profits, public sector, which require or permit the use of fair value. Now, what are the objectives of AASB 13? So it's twofold. One, it's about the measurement of the fair value of assets and liabilities, but it's also about what are the required disclosures. Now, fair value is such a hot topic, but it's received a fair amount of criticism over the years, especially during the global financial crisis. Therefore, there's this need that we disclose some more information about fair value. What assumptions have we used? What judgments have we made? What is the level of reliability of these fair value measurements? So that it's not only about measuring fair value, but what do we disclose about fair value? Very important, AASB 13 does not determine when an entity should apply fair value measurement. That is determined by all the other accounting standards. AASB 13 does, however, discuss and determine how to apply fair value. So that's its place and its spot within the standards. Important to note, AASB 13 does not apply to transactions where you've applied AASB 2, so share-based payments, and also not AASB 117 leases. So those two standards, you shouldn't go close to AASB 13. And the other thing that's quite interesting, there's often a bit of confusion between AASB 136, which is impairment of assets, and AASB 13. Now, this confusion is quite understandable Because AASB 136, impairment of assets, says that we have to determine the recoverable amount of assets in order to do impairment testing. And AASB 136 says that the recoverable amount is the highest of two things. Highest of, number one, fair value, less cost to sell, and number two, value in use. Very important to note, when you determine fair value as the first part of that test, it's fair value in terms of AASB 13. However, a very big however, when you determine that value in use, which is the second part of that definition of recoverable amount, value in use, you don't apply AASB 13. All right, so it's important to know that the standard makes it really clear that some measurements have similar characteristics to fair value, but remember they're not fair value. So value in use, which is part of the calculation of recoverable amount for impairment testing, it might have similar characteristics to fair value, but definitely it's not fair value. And the same goes for net realizable value when we look at AASB 102 inventories. So I think before we go any further, you would ask, Aletta, you crazy South African woman, what is the application date of this new standard in Australia? Now, it's effective for periods beginning on or after 1 January 2013. It's got early adoption is permitted, although I think we passed early adoption. Very important, the application of this standard is prospective. So what does that mean? In the first year of application of AASB 13, disclosures for comparative periods are not required. So you do the disclosures for the current period in that first year, but you don't have to go back to the comparative periods. I also want to explain this by looking at common year-end dates in Australia. So if you are a not-for-profit or any entity for that matter that have a 31 December year-end and you prepare general purpose financial statements, then AASB 13 should be applied for 31 December 2013. So if you're in the process of finalizing those financials, you have to look at AASB 13. If you have a 30 June year-end, obviously this standard would apply for 30 June 2014 financial statements, but please note, if you also apply half-year financial statements or interim financial statements at 31 December 2013, you also have to consider and prepare the disclosures in terms of AASB 13. So I thought at this stage, you've been listening to me for too long now, I might ask you a question. And the question is, in this instance, are you preparing financial statements for a for-profit entity or not-for-profit entity? So this is a really interesting one. To give you an idea, we have over 100 people attending, and if we look at that, 75% of the people have voted. And 83% of you are preparing financial statements for a for-profit entity and 17% for a not-for-profit entity, which is really interesting. And I think it's important, even if you're preparing financial statements for a not-for-profit entity, this is applicable. AASB 1004 requires fair value, and it's actually quite applicable to not-for-profit entities. So thank you very much for that. So I'll show you the results at the moment so you can see for yourself. We're doing research here. All right, thank you very much. So if we move on to the definition of fair value, AASB 13 defines fair value as the price that would be received to sell an asset. Please note, the price that you would receive to sell an asset. Not what you would pay to buy that asset today. It's not a replacement cost. It's what would you receive if you sell that asset, or if it's a liability, what would you have to pay to transfer that liability, to get rid of the liability? You have to pay something to get rid of the liability. In an orderly transaction between market participants at the measure date. So we need an orderly transaction, we need market participants. In essence, the definition of fair value, and this is crucial, is an exit price. So, and an exit price, we have to remember, is not the same as a transaction price on day one. An exit price is we want to get rid of an asset, we want to get rid of a liability. What would we receive to get rid of an asset? What would we pay to get rid of a liability? An exit price is what an entity expects to receive when we sell an asset, or to pay to transfer a liability. Now, therefore, fair value is therefore the price that would be achieved in a hypothetical transaction between market participants. So we ignore intention, whether we intend to get rid of the liability, whether we intend to sell the asset is irrelevant. It's a hypothetical transaction between market participants. So when we determine fair value, there are a few key elements to consider. So one is we need an orderly transaction. Number two is we need market participants. And then the third part is the market, so where this transaction would take place. So when we determine fair value, we have to consider orderly transactions, market participants, and the market. So let's look at each one of them. So if we look at the first key element, which is an orderly transaction, this is the primary determination. The primary determination, is the transaction. An orderly transaction would assume the following. This asset or liability has been exposed to the market for a reasonable amount of time to allow for marketing activities that are customary for transactions of similar assets and liabilities. It's very important. An orderly transaction is not a forced transaction. It's not a fire sale. So if we have a house, and usually it will take us a bit of time to put the house on the market, and we have an open for inspection for 4 weeks, and then we have an auction, then we would be looking for a similar process to determine market value if we are selling property. So we're looking at what is an orderly transaction for this specific asset. The other one, or the key element two, is market participants. So again, this is hypothetical counterparties. We don't need somebody who want to buy the asset or take over the liability. It's hypothetical. So the assumed characteristics of market participants are that they are independent. So we're not looking for related parties as defined in AASB 124. So it cannot be a parent entity, a subsidiary, an associate, a director of the entity, etc. They have to be independent. They have to be knowledgeable. So they need reasonable understanding of the asset or liability, using the available information, including information that they could gain or obtain through a due diligence. They should be able to transact. So we mean legally, financially. They should be able to transact, and they should be willing to transact. So they're not forced. They're not acting under duress. So this is when we look at market participants. Now the last one is to look at the market. Now the market in which this hypothetical transaction is deemed to occur, or assumed to occur hypothetically, and this is very important, is the principal market for the asset or liability. So when we look at the market, first instance, we look for the principal market. And now the principal market is assumed to be the market in which the entity normally transacts. So if we usually transact for a specific asset in a specific market, then that's the principal market. There could be a lot of different markets to sell an asset, but if we usually use eBay, then that's our principal market. Note that if the principal market is not easily identifiable, the entity should determine the most advantageous market to which we have access. So if we use a number of markets, we should say, all right, there is no easy way to determine the principal market where we usually transact. Now we have to look at the most advantageous market. But look at the order. It's always first, what is the principal market? And only if we cannot determine the principal market easily, then we look at most advantageous market. So let's go back. If we look at the market, we start with what is the principal market? That is the market in which the entity normally transacts. If there's no principal market, and only if there's no principal market, do we go on and identify the most advantageous market. So the third element, the market, this is time where you have to think with me, work with me. I'm inviting you to work with me. So example 1, let's say an asset is sold in 2 different active markets at different prices. An entity enters into transactions in both markets and can assess the price in those markets for the asset at the measurement date. So market A is the market with the greatest volume and level of activity for the asset. So we can the entity enters into transactions in both markets. So they say market A and B, we've got a price that can be received. We have transaction cost in that market. We have cost to transport the asset to that specific market. So the net amount that would be received for the 2 markets. So the question to you is, what is the fair value of this asset? So I'll go back to the previous slide if you don't have the information in front of you. If you look at this, what is the fair value? If you could please use the chat function and send me the fair value. All right, very interesting. Thank you very much for all your responses. Fantastic. We've got a wide spread of answers, so I think we better discuss. First of all, market A is the principal market. Why is market A the principal market? Because it wasn't clear which entity is the principal market. Therefore, we look for the greatest volume and level of activity. Market A is the greatest volume and level of activity. That was said in bullet point 2. Even though the proceeds in market B would be more advantageous, we don't have to look at more advantageous. The first question is, look at the level of activity. Yes, we've got access to both. Where do we transact usually? And that is market A. So that's the first part. And then the next part, and this is a tricky one. When you determine fair value, transaction cost in the market should not be deducted from fair value. So when you determine fair value, you will take into account transport costs to get it to the market, to get it ready for its sale. However, transaction costs in that specific market should be excluded. So very important. So fair value in this instance is actually 24. So the first step is we're going to look at market A, because that's where most activity is. Then the second step, so what is fair value? Fair value is the price of 26, and we deduct the cost to transport the asset to this market A, which is 2, and then we end up with fair value of 24. Please make a note, we do not deduct transaction cost in that specific market. So this was a tricky question. I've been naughty. Let's look at example 2. Let's say in this instance, 3 markets exist for entity A's fleet of vehicles. A has the ability to transact in all 3 markets and has historically done so. Right, so 3 markets we've transacted in all 3. Now again, I give you market A, B, C. I give you the price in each market. Then we look at the entity's volume for the asset in the specific market. So that is based on history and or intent. So how are we as an entity transacting? In which market are we transacting? And then there's a total market-based volume for this asset. So if you look at the whole market, where are people usually transacting? And therefore the next question is, so what is the fair value of the asset? So I give you a bit of time to think about that. What is the fair value of the asset? Again, using the chat function, if you can send me what you think. Thank you very much. I think it's 50-50 down the middle. Some people are saying 25,000. Many are saying 30,000. Thank you very much. I'll give it a bit of time. Some people are still thinking. Oh, it's 50-50. There's a question. How do we reply to your questions? On the right-hand side of your screen, you should see a little box that says questions. If you click on it, it would open up, and you can type me a message there, as if you're sending me a question, really. Fantastic, Michael. You found it. Well done. All right. Thank you very much. I must say I'm so impressed by the way everybody's responding to these questions. I'm just seeing answers appear. It's fantastic. Thank you very much. So in this instance, what is the fair value of the asset? First of all, you have to determine the market. And market B would be the principal market, as this is the market in which the majority of the transactions for this asset occur. So in this instance, and it's really important that we look at a market perspective. Because we have access to all 3 markets, because, you know, there's no real, if you look at the information, 3 markets exist. We can transact in all 3 markets. We have historically transacted in all 3 markets. It's a market perspective. The whole AASB 13 is about the market and not about the entity. And therefore, if the whole market is using market B usually, the fact that we often use market A or mostly use market A is irrelevant. We go for the majority of the people out there. It's not about our entity, it's about the market as a whole. And therefore, the fair value is actually 25,000. Let's look at another example, example 3, about the market. Let's say the asset is sold in 2 active markets at different prices. An entity enters into transactions in both markets and can assess the price in those markets for the asset at the measurement date. Neither market is the principal market, so there's no way, based on volume of transaction, to come up with a principal market. So how do we decide which one we're going to look at? So you look at market A, you look at market B, there's the price, transaction cost, the cost to transport, and the net amount you would receive. Again, my question is, So what is the fair value of the asset? Mark, I like your response, third time lucky. I hope so too, Mark. But I have a number of tricky questions today to get you all thinking. So please don't feel disheartened if you're not getting the right answer. I'm trying to illustrate the point. I'm making it tricky. I'm making it hard. We give a bit of time, see how many people get to the answer. I've got quite a number of people who get to the right answer, which I'm terribly impressed by, because this is tricky. Stacy, good answer. Ian, good answer. Annesley, good answer. Sorry, I'll go back to the previous slide. No, page up, previous slide. Dimitra, no problem. So that's the information. All right, question is, what is the fair value? Now, this is an interesting one because there is no principal market. Therefore, we have to determine, the second step, the most advantageous market. Now, if you look at the information on the screen, and if you take into account transaction cost and transport cost, etc., the most advantageous market there, taking everything into account, is market B. Therefore, we should look at the fair value in market B. Now, I can hear a number of you already screaming at me and saying, Aletta, you said earlier that when we determine fair value, we should not be including transaction cost in determining fair value. Now, this is the trick. You do not include transaction cost in determining fair value. However, you do include transaction cost when you try to determine the most advantageous market. Isn't that crazy? But that is the answer. So market B is the most advantageous market. And then if we look at market B, the fair value in market B is the price of 25 less the cost to transport the asset to market B, which is 2, and therefore the fair value in market B is 23. Now, I've made it a very tricky trend. I've made it like this to illustrate the point, because some people could have determined fair value and then looked at which one gives me the highest fair value, which is market A. However, first step is to see, is there a principal market based on activity levels? No. What is the most advantageous market taking transaction cost into account? It's market B. And then, all right, determine fair value in market B. And when we determine fair value in market B, we only deduct transport cost and not transaction cost. Trend, very tricky. The moral of the story is when you look at the definition of fair value, you should always remember it's a market perspective. It's always about the market. I'll give you a silly example because usually it's easy to remember these ridiculous examples. When we came to Australia 12 years ago, and I know you would have all guessed that based on my soft South African accent, we bought a car. And we still have that car. That is now the car that I drive to the station and back. Because I drop the kids at school, get to the station, it's an old car, not worth that much. I think the market would look at that car and say $2,000 if I'm lucky. However, for the Boshoff family, that car we can do magic with. I can drop off the kids, I can get to work at a reasonable time and do the return trip in the afternoon. And with that magic, the Boshoff family place a value on that car of $20,000. So what is the fair value of that car in terms of AASB 13? Market perspective rules, only $2,000. The fact that I can do magic with the car and in my view it's $20,000 and that this entity, this family can work magic with it is irrelevant. Fair value in terms of AASB 13 is not entity specific. It's market perspective. And therefore the fair value in my example would be 20,000. Right, now stopping your tracks. Important point. Often when we as entities or even auditors or business advisors, when we look at determining fair value for the preparation of financial statements, we get the experts in. We get the independent valuers in. Now please be careful. There is a conceptual difference between the definition of fair value under AASB 13 and the definition of fair value under international valuation standards. Now you have to remember that the international valuation standards are often used by independent valuers or valuation agents. So any values used for financial reporting that are obtained from appraisals, independent valuers, whether it's external or internal, should be consistent with the objective of fair value measurement in terms of AASB 13. So very important to take this into account. So you could ask me, I can hear you screaming at me, so Aletta, what is the difference? If you look at international valuation standards, they say fair value requires the assessment of the price that is fair between two identified parties, taking into account the respective advantages and disadvantages that each will gain from the transaction. And that's very different to what we have in AASB 13. In AASB 13, we don't have identified parties. Number one, it's hypothetical parties. Number two, and this is important, any advantages that would not be available to market participants generally should be disregarded when we determine fair value in terms of AASB 13. So the moral of the story, we have to be very careful where we get independent valuers, whether they're internal to our firm or external, whether they are actually understanding the requirements of AASB 13 and understand what we're going to do with this fair value. Let's move on to part 3, special considerations for non-financial assets. So there are some general rules. So in general, the requirements of AASB 13 apply equally to all assets, to all liabilities that should be measured at fair value. However, there are some special considerations if we've got non-financial assets, for instance, property, plant and equipment, which is a non-financial asset, and for liabilities. So if we look at highest and best use, now highest and best use specifically apply to a special consideration for non-financial assets. Now the concept of highest and best use says that the fair value of a non-financial asset is the price that would be paid by a market participant given the best use that can be made of an asset, irrespective of its current use. So the market is king, and the market would say, I don't care what you currently use the asset for, I'm going to look at what is the best use of this asset, and that would determine fair value. Now please note, because before we go any further, I want to make 2 points. Number 1, under AASB 13, an entity's current use of an asset is presumed to be its highest and best use. So we are making the assumption that the way we use this asset is its best use. It's presumed. Unless, and it's an important unless market, again the word market, unless market or other factors suggest that a different use of that asset by market participants would maximize its value. So we assume current use is best use. However, we should always consider whether out there in the market there are some indicators that other people could use this asset in a better way. Now, if such factors exist in the market, management of this client, of this entity, management of the entity is required to consider all relevant information in determining whether the highest and best use of an asset is different from its current use. So we can say our current use is assumed to be the best use. However, we cannot have blinkers on. We have to look around us, look at the market, see what the market can do with this asset. If there's a chance that the market could do weird and wonderful things, we should consider that. Right? So we should consider that. I can see there are some questions. I would come back to those. Unfortunately, I just want to get this done through first. So Daniel, Michael, I'll get back to you. If we go on to highest and best use, highest and best use is subject to the following constraints. A use that is physically possible. So we have to look at the location, the size of the asset, etc. We have to make sure that the use of this asset is physically possible. The second one is really important. It's legally permissible. And the third one, it's financially feasible. So we should consider the cost to convert to an alternative use versus return on an investment. Now, the one that I want to discuss a bit further is legally permissible. And I'll give you two examples. The first one, they're both kind of not-for-profit examples. The first one is, what if we've got a national park and we find out that this national park has some mineral reserves. And therefore, currently we use this park for recreational activities, for the public to use, but there's a better use. We can mine that, and then there's a better use, and we can make a lot of money. So what is the fair value? Is the fair value taking into account the mining activities, or is the fair value the use as a national park? Important that we consider the legal position. If this is the park that, according to the law of this country, or the state, or Melbourne, for instance, can only be used as a park forever and ever and ever, and in terms of whatever legal position, then the fair value should not take into account the alternative use to mine it. So you have to consider what is legally allowed. The other example, which is another not-for-profit example, what if we've got a not-for-profit entity? What if it's an aged care facility? Or any not-for-profit that have a building in a fantastic location, prime location. And we use that building as an aged care facility or for research and development cost or for admin purposes. However, the market is looking at that building and saying, listen, the best use of this building in this prime location would be residential development. Now we have to investigate. Legally permissible. It could be that there are zoning restrictions, and that building can only be used for certain purposes. We should also consider if we want to change those zoning restrictions, and there would usually be an approval process. Now, is that approval process a lengthy process, difficult, hard-fought? We have no idea what the outcome's going to be. Or, it's an approval process that's a kind of tick the box and there we go. So this is where judgment comes in. Whether we think that alternative use is legally permissible, realistic, we can see it in the future, and therefore whether we should consider that alternative use when calculating fair value. Another example would be if we have a golf course, and best use would be to get rid of the golf course, should I say roll Melbourne, and we're going to build houses there in the Balmoral area, etc. So we have to look at legally permissible, whether that's allowed. I think from a practical perspective, it's really important that you as management and directors of an entity, you need sufficient evidence to support your assumption about the potential for an alternative use. If we want to look at an alternative use to impact fair value, we should have sufficient evidence to support that alternative use. And that will be an interesting discussion. So let's look at a highest and best use example, and I would like to get you involved again. Let's say a company has a production plant which, due to some reduction in demand for its output, has been made idle for the foreseeable future. So we've got this plant, people are not buying our products, so we've decided we're not going to sell the plant at the moment, we're just going to leave it there, not use it. Management has received attractive offers to acquire the plant from interested parties, but due to strategic reasons have decided not to consider these offers at present. So we don't want to get rid of the plant, maybe demand pick up, and we don't want our competitors to buy our good plant. Whatever strategic reason, we've decided, we're keeping the plant, not getting rid of it, but we're not going to use it at the moment. How should the decision by management to make the plant idle and not to consider the disposal of the plant affect the fair value of the plant in the entity's financial statements? So I'll give you two options. Option one, we should write down the asset. This plant should be written down. It's got no value or less value because we're not using it. Or option two, it should not affect the fair value calculation. Thank you, Lauren. Thank you, Robert, for your prompt responses. Good thinking. I'm very impressed. Everybody's getting there. Everybody's hopping on. Thank you for your comments. Very important that the restrictions on the sale, before we look at that, it's very important that we remember it's all about the market. Now, the fact that management's not going to sell it or the fact that management is not going to use the asset, when we just look at fair value, it shouldn't impact it. It's option two. All right. We look at the market. The market is still willing to pay money for it. The market is king, and therefore it should not affect fair value calculation. All right, so that's the answer. I want to make another comment around best use, highest and best use. Restrictions on the sale or use of an asset will differ depending on whether the restriction is deemed to be a characteristic of the asset or whether that restriction is a characteristic of the entity holding the asset. So I'm going to read that again. If you want to consider there's certain restrictions on whether you can sell an asset or there are certain restrictions on how you can use an asset, let's say, how can we use a golf course? Our judgment will be influenced whether that restriction is attached to the asset or whether the restriction is attached to the entity. If the restriction is attached to the entity and it's saying this specific entity can only use the asset for this specific purpose, then that restriction should not be considered. However, if the restriction on how to use the asset is linked specifically to the asset, this golf course, Royal Melbourne Golf Course, can only be used for this purpose. Whether we sell it to another market participant or not, this asset, this golf course, can only be used for a certain purpose. Then we should consider it when we discuss fair value. Right, I want to move on to Section 4, Special Considerations for Liabilities. If we assume that the liability remains outstanding, assume that the liability remains outstanding after transfer and the transferee will fulfill the obligations, then no assumption of early settlement should be taken into consideration. So if we assume that this liability remains outstanding after transfer and that whoever's taken it off our hands will have to fulfill the obligation, then we shouldn't put in any assumptions around early settlement. However, fair value should take into consideration non-performance risk, including the entity's own credit risk. So what would be credit risk? the risk of the obligation may not be fulfilled as required. So there's always this discussion, should we take into account our own credit risk? And the answer is yes, we should take that into consideration. Also, when we look at liabilities, where liabilities of an entity are held by others, for instance, investors or other counterparties, the bank or lenders, the fair value of those liabilities should be determined from the perspective of the asset holder. So if there's somebody on the other side, you should say, what is the fair value of their asset? That should be the fair value of my liability. So that is, all things being equal, the fair value of the entity's liability should be equal to the fair value of the other or the counterparty's asset. All right? So that's only where the liabilities of an entity are held by others, so there is a counterparty. If there is no counterparty, for instance, where we have a decommissioning liability, so it's not an asset in the books of another party, it's a decommissioning liability. We have to repair the damage we've caused when we've mined here. In these circumstances, the fair value should be determined from the perspective of the market participant required to fulfill the obligation. So from a market perspective, if I have to repair the environment, what will it cost me? There is no counterparty position to consider. Valuation approaches is very important. So valuation approaches, AASB 13 does not detail which valuation techniques should be applied to measure fair value of assets and liabilities, but it does give us some valuation approaches, some broad approaches that are applied and underpin many techniques. And the three approaches that they talk about in AASB 13 are market approach, income approach, and cost approach. So let's look at each of them individually. What is a market approach? It's a valuation technique that uses prices and other relevant information generated by market transactions involving identical or comparable similar assets, liabilities, group of assets, liabilities. An income approach, this is a valuation technique where we look at future amounts and we convert it into a single current discounted amount. Now, future amounts, examples of future amounts could be future cash flows or future income, future expenses. So if you look at those future cash flows, you get discounted back to get to a current amount. So the fair value measurement is determined on the basis of the value indicated by current market expectations about those future amounts. So the income approach is an approach that could be considered. And then the cost approach is an evaluation techniques that reflect the amount that would be required currently to replace the service capacity of an asset, and it's often referred to as a current replacement cost. So there are different valuation approaches, and we have to pick the most appropriate in our circumstances. So if we look at valuation techniques, remember all these different valuation approaches, which we've just discussed, market, income, cost, underpin all the different valuation techniques that we use, that experts use. Now, valuation techniques used to measure fair value shall maximize the use of relevant observable inputs. So as far as possible, we try and use an observable input, something that's out there in the market. Remember, market is king. So try and use market information as far as possible, and then also try and minimize the use of unobservable inputs. So try and minimize the use of assumptions, judgments, etc. So that's very, very important. If there's market information, go for market information. The last thing I want to talk about, which is really important, are disclosure requirements. So we want to get to consistent, comparable disclosures. So users of financial statements get consistent, comparable information. I just want to say again, I've said it up front, but I want to say it again. AASB 13 must be applied prospectively from the beginning of the annual period in which it is initially applied. So what does that mean? In the first year of application of AASB 13, disclosures For comparative periods, so the previous year, the prior year, are not required. So if we look at the disclosure requirements, and they are outlined in detail in AASB 13, I'm talking about them in principle. AASB 13 requires fair value assumptions and information to be disclosed where applicable. So if there's no market information, but you're applying your judgment and you're basing it on certain assumptions, you have to disclose it. Now, these disclosure requirements are largely a copy of fair value disclosure requirements that we see in AASB 7, the disclosure of financial instruments. So as soon as you use fair value, we want you to tell us a bit more. How did you do it? How did you determine fair value? And that is really as a result of the pressure on the International Accounting Standards Board after the global financial crisis. Disclosure requirements, the key things, AASB 13 requires the same three-level fair value disclosures that were introduced in AASB 7. So if you look at level 1, it is quoted prices in an active market. In level 2, fair value determined using input derived from market information. So level 1 is there's a quoted price on the Australian Securities Exchange. Level 2, there's not a quoted price on the Securities Exchange, but we can go to the market and we can look at similar assets. So my house is next door to my neighbours, similar size, same area, similar block of land, both about 5 years old. They sold it for X amount, therefore ours should be similar. So it's not listed on the Securities Exchange, but it's market information. And level 3, which is the least reliable, would be fair value determined primarily from inputs reflective of management's expectations. So level 1, very reliable. You can see it on a quoted market. Level 2, less reliable because we're just looking at comparable assets and liabilities. Level 3, now we're down to there is no market information, etc. Management is applying their judgment, basing it on certain assumptions and expectations. Therefore, there are additional disclosure requirements if you have used level 3 to determine fair value. So you have to disclose your total gains and losses for the period, recognized in profit and losses, and a description of where they are disclosed, total gains and losses recognized in other comprehensive income. You have to look at purchases, sales, issues and settlements during the year. You have to look at transfers in and out of level 3 and why are you transferring in and out of level 3. So it's a real reconciliation of opening fair value to closing fair value. Now at this stage, I want to ask you to participate again. Things to remember. In the chat function, what are the things that you think we should remember going forward? So for your entity, if you are in the boardroom, make a list of things that you've learned today that you think we should consider and remember going forward. I'll give you a minute to consider, and then I'll give you a few suggestions. Please don't go quiet or shy on me. I'm sure you've learned something. If you can put it in a sentence. Yes, Alan, definitely. It's all about market and not the entity. Michael, yes. We have to look at, is there a readily accessible market for the asset? Mark, yep, market is king. I agree with you, Ben. Consider the factors. Yes, important. If there's no principal market, we have to consider the most advantageous market. Philip, yes, transaction costs should not be included in the calculation of fair value. I think we get confused with that one, Philip, because AASB 136, when we look at impairment, we include transaction costs. Agreed, Michael. Thank you very much for your feedback. Natasha, yes, highest and best use concept, very important. I think for our clients, I was trying to put myself in your position and thinking, what would I like to, what take out? First of all, as a lot of you have said, market-based and non-entity and specific. I think it's important that we note that there would be an increase in the costs and time to prepare these fair value disclosures. Please don't underestimate the increase in time to prepare these fair value disclosures. Remember, it's about a current exit price. Then, very important, the current exit price is not the same as a transaction price on day one. That is an entry price. It's about the principal market, and if there's no easily identifiable principal market, we look at the most advantageous market. Highest and best use we have to consider. And then I think a key takeaway for our clients, but for our partners and staff as well, is to review and consider our current methodologies and assumptions to ensure that they comply with AASB 13. Very important. And a few other things to remember. The new AASB 13 may impact the selection of an appropriate valuation technique. We might have to consider consulting with a valuation expert, internal or external. Remember, when we use these independent valuers, consider that we give them very detailed instructions about AASB 13. Remember, there's a difference between their standards and our accounting standards. There's this emphasis on a market perspective, and it's not a valuation based on current use if there is a better use out there in the market. And there's a lot of judgment based on that. So if we look at a to-do list, Wendy, I've got your question and I'll come back to that. Thank you for your question. A to-do list, identify the items measured at fair value. So if you're sitting there, think about your balance sheet, your statement of financial position. What items are measured at fair value? Number one. Number two, evaluate whether the current basis for the fair value of these items are in accordance with AASB 13. Consider whether independent valuers should be consulted. Consider what instructions we will give to these independent valuers. Wendy, your question is around what is a non-financial asset. We have to look at what is a financial asset, and that is defined in AASB 132 and AASB 139 when you look at financial instruments. So a financial asset is usually something that is cash, or there's a contract to receive cash, similar to financial assets. So as soon as it's not a financial asset, it's not a financial instrument, it's a non-financial asset, and that would be, property, plant and equipment, investment property, intangible assets, etc. Wendy, another good question. I'll get back to you on that one. Before we talk about a few questions, before I log off, my shower question. As you know, there's always a shower question. How can we ensure that our independent valuers comply with AASB 13? I don't think there's an easy solution to this one, but it's something we should think about. As partners here at Pitcher Partners, or staff at Pitcher Partners, or clients, as soon as we use these valuers, how can we ensure, how can we make it easier? What measures can we put in place to ensure that they comply with AASB 13, because that's what we want. So the roundup, there were 7 sections which we've covered. I hope you were happy with those. If you've got comments or questions, please put it in the question box. I'm going to stay online and try and respond to those questions. However, if you have to leave, our hour is up. It's 12:05. Aletta's been going like a steam train again. Thank you for attending the webinar. I am hoping that you'll be able to join us in future. If you would like to join us, please send me an email if you don't have all the invitations login details. The next webinar is on Friday, 28th February. The next financial reporting and accounting webinar is on Friday, 28th February, same time, same place. And please contact me with any feedback, comments, suggestions. If you have to leave, thank you very much. Have a wonderful weekend. When did you come back to your question? I hope I understand your question, and that is, can you advise when we apply this standard and the impairment standard? Now, as soon as you have to determine fair value in terms of any accounting standard, there's no rules in any of those standards anymore on how to determine fair value. So you'll have to go to AASB 13. There's often a bit of confusion with the impairment standard, and that is, when you do impairment testing, you have to compare the carrying amount in your statement of financial position with the recoverable amount of that asset. And if the recoverable amount is less than the carrying amount, you have to write the asset down. So when you do that impairment test, if you have to do the impairment test, and remember there are indicators on when to do impairment testing, but if you have to do the impairment test, and that recoverable amount is the highest of two things. It's the highest of fair value, less cost to sell. Now when you look at that alternative and you look at fair value, you determine fair value in terms of AASB 13. And then you deduct cost to sell to get to recoverable amount. The second alternative is value in use, where we're saying, listen, I don't care what the fair value in the market is. I can work magic with that asset. I can use it in my organization. These are my future cash flows. If you look at that value in use calculation, you don't apply AASB 13 to do that. I hope that answers your question, Wendy. Perfect. Wendy, and again, apologies for getting the details to you so late. Thank you for calling me. That's wonderful. So at this stage, I'm saying thank you very much to all of you. We'll speak again.